All right, welcome to The Explainer. Today, we're diving into something pretty wild, a strategy that claims you can basically skip decades of saving for retirement and get there in just a few years. So how on earth is that supposed to work? Let's find out.
Yeah, that's a pretty bold claim to start with, right? Punch a wormhole through the old way of doing things. So, before we jump into this so-called wormhole, what exactly is the traditional rule that it's trying to blow up?
Okay, so to really get why this new idea is considered such a shortcut, we've got to first understand the old way. The long, slow marathon to financial freedom that's been the playbook for, well, forever.
And really at the center of that whole marathon is this thing called the 4% rule. It comes from this famous study, and the big idea is that you can safely pull out 4% of your total investments every single year, adjust for inflation, and you won't run out of money. It's kind of become the gold standard for figuring out just how big that retirement nest egg needs to be.
Now, the math behind it is super simple, but the number it spits out, oof, it's a big one. To get, say, $50,000 a year to live on, you need to save up 25 times that, and that comes out to a whopping $1.25 million. Yeah, for most of us, that means working for a very, very long time.
Okay, so that's the long road. Now let's check out this supposed shortcut. The source material lays out this whole alternative strategy, and it's all built around two specific high-yield investments that the author calls Stride and Stretch.
So what are these things? Basically, the strategy uses two kinds of preferred stock. You can think of them as a hybrid, kind of like a cross between a stock and a bond, and each one has a totally different job to do. Stride, that's your high-octane rocket fuel. It's built for high yield, but it comes with more risk. And then there's Stretch, which is supposed to be the stable foundation, just steadily churning out income. And yeah, just look at these numbers for a second. The source really hones in on this. Stride is trading way below its face value, its $100 par value. And because you can buy it on the cheap, its effective yield skyrockets to over 12%. Stretch, on the other hand, is the stability play. It trades much closer to its par value, so the yield is a little lower, but you get that nice bonus of a payout every single month.
Okay, so here's the million-dollar question, or maybe the less than $1 million question. What happens to that giant retirement number when you're suddenly making 10 or 12% in income instead of just pulling out 4%? Well, the difference? It's huge.
Right. The whole claim is that you can get the exact same annual income with way, way less money saved up. Let's actually put some numbers to this and look at a real-world example from the source material to see what this looks like in practice.
And boom, here it is. This is the whole ballgame. If you want that $50,000 a year lifestyle, the old 4% rule says you need that massive $1.25 million nest egg. But if you're using Stride with its 12.64% yield, that target number just collapses down to under $400,000.
I mean, that's just a staggering difference, right? You need more than 3 times less capital. According to the source, that is the gap between retiring while you're young enough to enjoy it versus, well, retiring much, much later. It completely flips the script on how long you need to save. So, look, this isn't just some abstract idea. The source material actually lays out a concrete, step-by-step playbook for how you would actually go about putting this strategy to work. And this playbook really does take it from theory to practice. It walks you through the whole process. Step 1, figure out exactly what you spend and add a little buffer. Step 2, decide how you're going to mix Stride and Stretch, all the way through to using tax-advantaged accounts, reinvesting your dividends, and this is key, keeping an eye on the health of the investment itself. And then finally, Step 6, flipping the switch and starting to live off that income.
And the potential impact this has on your career timeline is just dramatic. According to this model, a classic, boring 60-40 portfolio could take you 21 years to hit your goal. But look at the other side. An all-in Stride strategy could, in theory, get you there in just 5.5 years. You're literally shaving off more than 15 years of work. Okay, but let's be real for a second. You don't get these kinds of eye-popping returns without taking on some serious risk. It's not a free lunch. And to its credit, the source material is very clear about this and spells out the key risks you'd have to be comfortable with.
So, the author points out a few really important things to keep an eye on. For Stretch, there's a risk the company could change the interest rate. There's also liquidity, meaning it might not always be easy to sell your shares exactly when you want to. And then there's call risk, which is basically the company's right to buy back the shares from you, which could limit your upside.
It all comes down to the health of the company's finances.
And this right here is probably the biggest red flag for Stride. The dividends are non-cumulative. What does that mean? It means that the company's board decides to skip a payment. You just don't get it. It's gone. Poof, forever. They don't know it till you later.
So, when you boil it all down, the strategy is presented as a very personal choice. It's a trade-off. Think of it like a dial you can turn. On one side, you have the speed, how fast you want to get to retirement. On the other, you have stability and safety. You have to decide where on that spectrum you're comfortable sitting.
And that really brings us to the big final question, doesn't it? Is this some kind of retirement revolution? A new math that changes everything? Or is it really just a high-stakes bet? A bet on a single company and its very specific strategy involving Bitcoin? The source material makes it clear. This approach completely changes the retirement equation. But your success is tied directly to the fate of one company. And that choice, as they say, is up to you.